Hi guys, how are you all doing? Thanks to everybody who's after joining us so far. I'll just leave it another couple of seconds there just to allow some people to filter in. You're all welcome to this evening's webinar, which is specific financial advice for company owners, directors and senior managers. Really do appreciate everyone's time, particularly at this type of the year and when there's World Cup games on and stuff. But look, it is timely as we're coming up to company year ends and tax deadlines for companies and stuff like that. So look, I'm positive people will get a bit of value from it. My own name is David Looney. I am a financial planner with Alpha Wealth, and I am joined by some of my colleagues on the webinar today as well. So feel free to pop some questions into the chat box if anybody has questions throughout. And look, we'll do our best to get to them at the very end. For those of you who don't know, we actually have been doing a lot of these online financial webinars over the last couple of years. You can see most of them on our YouTube channel, Alpha Wealth. And we will be kind of, I suppose, doing a lot more in the new year. This will be the last one of 2022. So just keep an eye on our social media channels and stuff for some of the ones that might be following in the new year. So for those of you who don't know, just to give you a quick introduction to who Alpha Wealth are, we basically run a impartial financial planning company headquartered in Little Island in Cork. We've 8 advisors in Alpha Wealth who basically provide financial advice to like business owners and individuals and families from pretty much all walks of life, and give them advice in many different areas of personal financial planning. We are a central bank regulated company. We've over 60 years of experience between our advisors in Alpha Wealth. And we're happy to say that we have over 3,000 clients from all around Ireland. That's this stage, which we're adding to on a daily basis. And those clients currently have over 120 million euro of assets under management with us. And I think one of the important things for our clients and for ourselves is that we are impartial advisors, which means, we're not a tied agent for any product providers in the market. We're not trying to sell anyone products. It's about, trying to find the best solutions for our clients and get them into the very best financial situation, whether they are, a company owner or a PAY individual. So the 7 key takeaways from tonight's presentation are firstly, step number 1, and something I think is very, very important for everyone to do, is establishing your financial goals and basically positioning them into short-term, medium-term and long-term. And we're going to talk a little bit then about how you can reduce your company's tax whilst creating personal wealth for yourselves. We're going to focus a bit on how you can get your personal savings and company savings working a bit harder in the environment we're in at the moment. We'll talk a little bit about how you can reduce your personal tax then as opposed to your company tax. We'll spend a little time discussing how your business can protect you, your family and your staff, and just some tools around employee retention and hiring there. Speaking to a lot of my clients that are business owners, they're finding it really challenging at the moment to, get staff and get the right staff. And, we're finding that ourselves. And that's why I think it's more important now than ever to have, good employee benefits in place to attract talent and retain talent. So I'll be spending a bit of time talking about that. And then we'll move on to things like exit planning and how partners in a business can get up to 1.5 million tax-free from their businesses on exit. And finally, we'll just be discussing a bit on company cars and benefit in kind, just in light of the changes in legislation from next year there. And as I said, we will be opening it up to a Q&A session at the end. As I mentioned from the start, this webinar is, I suppose, applicable to both company directors and PAY and certain PAY individuals who might be like directors or senior managers in companies. So look, I'm confident everybody will get some takeaways from it. So as I said, step 1 for me when we meet new clients, regardless of their situation, is always trying to establish their financial goals. And I'll hear many different things from different people, things like becoming debt free, saving to buy a property in however many years, building up a nest egg, saving for children's education, saving so they can retire at a certain age, becoming financially independent, making sure that their families are looked after in the event of the unforeseen, reducing their tax, or even a combination of all the above. And Alpha Wealth's role really is to help you identify these financial goals, but more importantly, to put a roadmap or a financial plan in place and how you're going to achieve them. And what we will do is help people manage their money effectively and help them find that balance to, make sure that they're allocating the right amounts of money to the right pots to meet their financial goals. as I said earlier, it is really important that you do position your financial goals into, I suppose, different time frames. So over the short term, the medium term, and the long term. And the reason for that, of course, is that the most efficient way to operate your finances is that you would essentially have a separate pot of money for each of your goals depending on the time frame. So what I mean by that is that, you know, for anything that's coming up in the short term, so things that might occur in the next, say, 0 to 3 years, you'd be using there like a standard bank account or a, you know, corporate deposit account where, you know, it's safe and it's accessible. Then if you're looking at medium term goals, so expenses that you're planning for in the next 3 to 10 years, the normal savings account is kind of out the window and not very appropriate. So there you want to be looking at like investment savings plans, getting the money working for you, keeping pace with inflation. And then obviously the longer term goals, things that are happening in, you know, 10 to 20 years or beyond, or, you know, trying to reach this ultimate goal of financial independence, we'd be using, you know, retirement planning vehicles, pensions, etc., because they are the most appropriate, you know, vehicle for those long-term savings. And really, for us, it's about helping people to find the right balance between all three of those and make sure that you're, you know, funding the appropriate vehicles and the appropriate pots relative to your goals and the timeframes that you have in mind. So when I'm speaking to my clients that are company owners, I think, you know, one of the main challenges that they'll come across is that they're accumulating money in their company account, but when they're trying to get that out of their company and get it into their hand, they're left with a bit of a dilemma in that they're going to lose a significant amount of it to Mr. Taxman, particularly if they're already, you know, bridging on the standard rate or the standard rate cutoff and venturing into the top rate of tax, because if they take any more from their business, it's subject to 52% tax inclusive of income tax, USC and PRSI. Now, people need to appreciate, firstly, that the most powerful tool that they have in their armory to get more money out of their business is a pension. And before people switch off and think this is a pensions lecture, it's not, but it is without a doubt the most effective way to extract money out of your business in a very, very tax efficient manner. And the reason for that, of course, is that pension contributions from your company to your pension or to your staff members' pensions, they give no rise to income tax or BIK in your personal hands or your employees' hands, and they give no rise to employers' PRSI or corporation tax for the company. So it's a win-win. And the limits on how much you can fund pensions from company accounts is very, very generous. You know, directors have huge scope in terms of how much money they can put into pensions, and that's why it even makes sense for directors and people to fund pensions, you know, the months right before retirement, because it's a great way of getting money out of your company and avoiding paying too much tax on it. The table down below just gives a clear example of that. It compares taking €1,000 as a salary increase into your hands or into your employees' hands versus giving it as a pension payment to yourselves or them. Firstly, we look at the impact to the company, and then we look at the impact on the individual. So €1,000 of a salary increase, obviously the company is going to have to fund employers' PRSI. So that's going to cost the company €107.50 to pay that €1,000 salary increase. There's no tax relief on it, and the net cost to the company in that case is €1,107.50 to give €1,000 salary increase. In contrast, if you were to instead put that €1,000 into your pension or your employees' pensions, there is no employer PRSI to be paid. You get corporation tax relief on the contribution, saving €125. So the net cost to the company is just €875 versus €1,107.50. So a difference of €232 there, or a 23% saving. Now, if you look at the impact that that's going to have on a personal level, if the employee takes the payment as salary and they're a top rate taxpayer, they're going to receive about €490 into their bank account, therefore losing half of it. Whereas if they get it into their pension, or you get it into your pension as a director, the full 1,000 is actually arriving into your pension. And not only that, it is growing tax-free to your retirement. And you also have scope to do this for, you know, family members and spouses who might be employed by the company. So there is a massive opportunity for people to do that and fund pensions quite tax efficiently. Now, when I speak to clients about pension funding and retirement planning, they'll often ask me how much of a fund is enough or what should I be aiming for. And while I stress that it is really dependent on the individual and your spending and lifestyle habits, I find that the sweet spot for our average client is a fund value of somewhere between 600 to 800 grand. Now, while that may seem like a very large pot to some people, you need to appreciate that people are living a lot longer. So it's not unusual for someone to be spending 20 to 30 years of their life in retirement. So a pot like this is, appropriate to stretch over that kind of period, particularly if somebody wants to retire earlier between, say, 55 and 60. So the reason I say that is that 600,000, firstly, it allows you to get 25% of the pot as a tax-free lump sum. So you're talking about 150 grand there. A lot of people might use that to maybe clear off any existing balances on their mortgages if they're looking to, take early retirement, or set themselves up for retirement with their lump sum. And then you're left with 450,000 in the fund that you're going to use to draw down an annual income from. Most people would take about 5% per year from that fund to try to stretch it out as long as possible, which is going to give you income of 22.5 grand a year. Now, the state pension also kicks in from 66, which is about another 13,000 euro per year. So between both sources, you're coming up to about 36 grand a year, which is currently just under the top rate tax threshold. It's actually increased to 40 grand from next year. So people have a bit more scope there as well. And we need to appreciate as well that generally life is a little bit cheaper in retirement, in that kids are usually no longer dependent, mortgages are usually cleared off. So I'd like to think that, an overall income between, say, 36 grand and 40 grand a year should be enough for someone to live comfortably on. Now, a lot of people would say to me, look, David, what if I retire at 60 and the state pension doesn't kick in till 66? Where do I get my additional income from those 6 years? And that's where the lump sum comes in handy, because what you could potentially do is draw down the lump sum over that 6-year period to bridge the gap, then stop drawing your lump sum and the state pension kicks in. 800,000 in my mind is an ideal pot to be looking at, because if you take 25% of your fund, again, you're getting 200,000, and that's actually the maximum tax-free cash that you can take from all pension sources over your lifetime. So getting to 800,000 makes sure that you're getting the maximum amount of tax-free cash from a pension, and then the remainder of 600,000, you'll earn 36 grand a year plus the state pension on top of that once it's payable. So obviously we talked about pensions and longer term financial planning, but what about, I suppose, expenses or, money that you might need before that? So potentially over a 3 to 5 year plus period. And the one challenge people have and companies have there, of course, is that a lot of people that I meet have too much money sitting in bank accounts, credit union accounts, post office accounts, and it's earning 0% interest. So it's not working for them. And in the meantime, inflation is happening in the background. Everything is getting more expensive. So you're getting, guaranteed loss or a loss of purchasing power on your money or your corporate money over a long period of time, which can be quite devastating. So at Alpha Wealth, I suppose we're always trying to get people into a position where they have, savings and capital behind them to finance some of those expenses that are coming up in life, whether that's getting on the property ladder, buying a car, or even any business expenses, but also make sure that their savings are growing for them and they're accumulating wealth in an efficient manner. And interest is so important, particularly over a medium to longer period, as I said, to keep pace with inflation. So if you look at this example, if you do want to build up a fund of, say, 30 grand over the 4-year period, if you're not earning interest, you need to save 625 euro. Whereas if you are earning a very achievable interest rate of 3.5% per year, you only need to save 570 euro. So you're about 55 euro better off per month saving into an account that's giving a modest enough interest rate versus using something like a credit union or a post office account. If you're in the fortunate position that you have a lump sum to kickstart your savings plus 400 a month, you'd only need to save 400 per month if you have a lump sum to start it off, again earning 3.5%. These are just some other examples there of how you can accumulate a lump sum of 30,000 over a many different time periods. For example, if you're saving 250 per month, it would take you just shy of 9 years to do so. Now, many people are probably wondering, where can I get interest on my savings or my company savings, given that the bank isn't giving me any? And as I stressed from the start, we're not tied to any providers in the market, but the one plan we do use for our clients, and it's the plan I use for myself, is a plan from Zurich, who are the largest insurance company in Ireland, one of the biggest fund managers in the world, very reputable company. But they have a plan called the Easy Access Savings Plan, and this is really applicable for company savings, personal savings, lump sum savings, regular savings. In my mind, really, it is the all singing, all dancing alternative to sticking money into your bank, credit union, or post office. A lot of my clients would use this for saving up a fund for kids' education and put the child benefit into it. But basically what it is it allows you to save on a monthly basis from €100 per month, or put a lump sum into something. As I mentioned, that can come from a company account or a personal account. It's a very flexible plan in that it gives you the ability to increase, decrease, stop and restart your savings at any stage. And it gives you the ability to access that money at any stage. So you're not tied into any fixed term period. You can access your savings or your corporate savings at any stage at no penalties, which is why we like the plan so much. Now, where it differs from a normal bog standard savings account that the bank might offer you is that you get to access a wide range of Zurich savings funds that all have really good long-term track records. And there's many different risk and reward levels in those funds. So there's an option there for everyone, really. And that risk and reward level can be changed throughout the term. Usually, the rule of thumb is that the longer the time frame that you have in mind, the more risk you should take on board, because higher risk funds will generate higher returns. And whilst they can be more volatile over shorter periods of time, that shouldn't really, I suppose, upset people, because funds will recover over longer periods, as they always have, if they are diversified and well managed. Now, the thing to bear in mind is that any broker or any provider in Ireland can offer you this type of plan, but it's about setting it up through, I suppose, somebody that you can trust, have a relationship with, and someone that's not going to charge you an arm and a leg on fees, because you can have the best investment performance. But if fees are too high, they're just eating into that. So firstly, what we do is make sure that 100% of our client savings are invested in that plan. And we actually give an extra 1% to cover the government levy on the plan. And the annual management charge then is quite low. We bring it down to the base, which is usually about 1.3 to 1.5%, depending on how much you're saving into it. I worked for the banks for a couple of years before I joined Alpha Wealth, but they used to sell these similar savings plans at scary charging structures. You know, I usually came across like 97.5% allocation. So not only was somebody losing 2.5% on anything that they were saving, they were losing the government levy as well. And then on top of that, they had an annual management charge, which could be as high as 2%. So, you know, any fund that was doing, say, 5, 6, 7% per year, the bulk of that, if not all of it, was eaten up through charges alone. And so while people thought the funds were performing poorly, in reality, it was that the charging structures were too high. So just be really, I suppose, mindful of what plans you have and what you're paying. And of course, we are happy to review plans for people to make sure that they are, you know, saving money and getting exposure to the best options out there in the market. So some people might be a bit nervous or cautious at the moment, which is understandable given the, you know, economic outlook. And it's coming back to this, I suppose, concept of investing over the long term, as I mentioned earlier. And investments or funds are really, really resilient over longer periods of time. So one of the funds we use quite a lot in Alpha Wealth is a fund called the Balance Fund. It's one of the oldest funds in the market. It's around since 1989. So it's been through a very, very long period of time. It's had a lot of challenges, such as 2008 financial crash, and it has been really resilient over that. So markets have had a terrible time this year. We're not going to shy away from that. It's normal. It happens every couple of years. So while this fund is down 13% in the last 12 months, our clients are not going into this fund drawing on their money after 1 year. They're keeping it there for at least 3 to 5 years, if not longer, to ride out any of that short-term volatility. So if you look over a 5-year period, despite markets falling 13% this year, or this fund falling 13%, the fund is still up 30% over the last 5 years, despite all the challenges that we've had, namely, you know, COVID, war in Ukraine, you name it. The average returns generated from this fund are close to 10% per year, even at a low point in the market now. So it really doesn't matter what's going on in the, you know, global economy, as long as you're getting exposure to a diversified portfolio and keeping that long-term view in mind. And that goes, of course, for corporate savings and personal savings. So we spoke a little bit earlier on, using pensions to reduce your tax, but there is one other scheme that I want to make people aware of, which is a scheme called the Employment Incentive Investment Scheme. Now, this is a scheme to reduce your personal tax, so it is only applicable to, I suppose, personal money that you can afford to invest. But basically, it's a scheme where you can lend money to growing Irish companies. There are, maybe close to 100 companies every year that will try to raise capital under this scheme. And the benefit in doing this scheme and investing with those companies is revenue will actually give you a 40% tax break on your investment amount as a top rate taxpayer. And then you also get a return from the company for the use of your money. So outside of pensions, it is the only scheme or vehicle in Ireland to reduce your tax at a very high level. Yes, on a smaller sense, you have things like claiming back on medical bills and tuition fees, but I'm on about, really saving thousands of euro on tax every year. And this scheme does that for people. It is a revenue-backed scheme. The minimum investment is usually about 5,000 euro per company. So it's, a bit more accessible than some people might think, noting that they're going to get 2,000 euro of that $5,000 back in just a couple of months' time when they're due their tax return. And you do also get a return from the company, as I said, which is usually in the region of about 20 to 30%. So just to give people an example of how it might work over the next couple of years for them, let's say you have 10,000 euro this year that you don't need over the next 5 years, and you're looking to, generate a good return on your money and reduce your tax bill. You can invest that 10 grand into an EIS company or EIS option. And when you do your tax return at the start of 2023, just a couple of months' time, revenue will kick you back 40% on the investment. So that's 4 grand coming back to you, guaranteed, which makes the net cost of your investment just 6,000 euro. Now, in year 2026, which is year 5, it's typically a 4 to 5 year scheme, okay? You will get your 10,000 returned, plus, let's say, a 28% interest from the company. So that's 12,800 coming back to you on an investment that had a net cost of just 6,000 euro. So that's more than an 100% return over a 5-year period, inclusive of the tax relief. It does absolutely come with its risks, and that's why it is so important to pick a solid company. And I suppose Alpha Wealth's role as a financial advisory company is to look around at some of the EIS options every year and cherry pick the top 2 to 3 every year as a viable option for our clients under the schemes. And there are some excellent companies raising capital this year, which I can give you an example of in a second. Now, one, I suppose, roadblock for maybe some company owners when it comes to the scheme is that they're manipulating their salaries to avoid paying too much at the top tax at the top level. So maybe A, they don't have capital in their account that they can afford to put away for 5 years, or B, they're not top rate taxpayers. But you can actually use the scheme as kind of a wealth extraction tool from your company as well. If you take a large bonus from your company, suffer the tax on the money, and then stick the net amount back into EIS. So for example, if you look at this here, okay, let's say an individual took a bonus of 20 grand and put it into the EIS. After top rate tax, they're going to come out with about 10 grand in their hand. They're going to invest it in EIS, let's say over a 4-year period. They get their 4 grand tax back, plus the EIS return, which is coming out with about 12,100 net of the tax and the fees. So they're basically coming out with 16,000 euro on their 20 grand taken from the company. Now, if they weren't to use EIS and take 20,000 out of their company, it's all subject to 52% tax. So they're going to come out with about 9,800 versus the 16,100 if they're using something like the EIS scheme. So it's effectively kind of like reducing the tax rate to 20% instead of 52% from taking money out of your account and using a vehicle like this. As I mentioned earlier, there are some excellent companies that raise capital every year, and one of the companies that are raising capital this year, and one of the companies we're working with, is a company called Blacks of Kinsale. They are a phenomenal company. They're established since 2013, so they have a good track record. The company is presently valued at about 15 million euro, which is incredible given the short trading period that they've had. Their revenues last year were about 2.1 million, of which 700,000 was profit. They're on track for about 3 million this year. They have many, awards across their different product ranges, which includes craft beer, Irish whiskey, gin, rum, and they are in a very supportive market. So Irish whiskey is currently the fastest growing spirit worldwide, and people can probably see that the craft beer market has really, I suppose, exploded over the last couple of years. And alcohol, look, arguably is a bit of a recession-proof product. It always tends to sell well in good times and bad. What Kinsale, or what Blacks of Kinsale are using the funds for, is to set up a new multi-distillery and brewery in their site in Kinsale that you can see here. It's going to have like a visitor centre and a bar, so you'll have like multiple, I suppose, revenue streams for the company. It's going to be the largest multi-distillery brewery in the country. They're looking to raise about 8 million through private equity, bank debt, and the EIS scheme to do so. And they're basically paying people a 28% capped return over a 5-year period, in addition to the 40% tax relief. So while there are a lot of, say, early stage startup companies looking to raise EIS capital, you can see that there are some really established companies as well. And we're happy to speak to people a bit more on that. If they reach out to us, I'll be sharing my contact details at the end, and I'm happy to speak to anyone on a one-to-one basis. There are some other EIS opportunities as well that we're happy to talk to people about, including a EIS fund where people can invest in, a couple of different companies through a fund rather than just specific companies. So what I want to talk about now is basically ensuring that your company is protecting you and your family and your assets as tax efficiently as possible. So basically at Alpha Well, we feel strongly that if you are the director of a company, a limited company, or a company owner, you shouldn't really be paying for a lot of personal policies yourself, because what's the point in taking, a hit on your salary and paying for policies from after tax salary, therefore reducing your disposable income, when you can get your company to pay for these policies and get the same benefit. So if any company directors have things like life cover, serious illness cover, income protection, and they're paying for it through their personal bank account, there is a more tax efficient way to operate. In fact, the only policy that you should be paying for personally is decreasing mortgage protection. And as we've noted here, I usually suggest that people shouldn't be paying more than about €25 per month, unless, of course, they were loaded on health grounds. A lot of people I meet are paying way over €25 per month because basically they were sold the policy by the bank and they added on so much extras that the clients didn't even need, that they're paying way more than they need to. So what we can do there for people is to review your existing cover, reduce the cost of it, and get you structured more tax efficiently, get your business to pay for everything else. The premiums are deductible against corporation tax for the company, and as I mentioned, you're not bearing the cost of it on a personal level, which is increasing your disposable income. So for example, did you know that you can actually get your company to insure your life for 4 times your salary? It can get tax relief on the cost of that policy, and should you die, the proceeds, which are 4 times your salary, will be paid as a tax-free lump sum to your estate without giving rise to any benefit in kind or tax implications. That type of policy is extremely cheap. It usually costs about €20 per month or less, and then there's tax relief for that for the company. Similarly, your company can also insure your income, something that I believe everyone should have. Again, the company gets tax relief on the cost of that policy, and if you can't work due to sickness or injury, the policy will kick in to replace your income, take the pressure off the company, and there's no like benefit in kind or anything like that in that. As I mentioned earlier, a lot of my clients, and maybe some people on the call today, are probably finding it really hard to get employees at the moment. There really is an employees market. It's very, very competitive, and it's hard to not only, I suppose, attract employees but keep employees. And that's why I think it's more important now than ever to make sure that companies have a really good benefit package in place. I remember when I was working for the banks years ago, people were terrified to leave the bank for fear of losing the great benefits that they had, like debt and service and income protection for their families. I was 20 odd at the time, so I wasn't really thinking about that, but a lot of people were. So some of the policies that you can put in place for your staff and yourself, particularly if you've more than 3 employees, include things like debt and service benefit, which is the 4 times salary type of cover I alluded to earlier, and group income protection. So you can basically insure all of your employee salaries, or maybe certain groups of employees rather than just yourself. The benefit of it going with, I suppose, a group policy, and that's more than 3 employees, is twofold. One is that it's much more, it's much cheaper basically than putting individual policies in place. So for example, you could get, 6 to 10 people insured for the same cost of maybe putting, 2 or 3 individual policies in place. And separately, there's basically something called free cover limits that apply to group protection policies, which means that everyone gets free cover up to a certain limit without the need to basically complete medical forms. So even if somebody has pre-existing conditions, believe it or not, they can get covered up to a certain level. I came across, I suppose, a company recently whereby one of the directors had a bit of a health history and he was finding it hard to get covered by himself. So what they've done is they put these group policies in place for both directors, and one of the a wife of one of the directors who was also being paid from the company. They got really good value on doing so, and the guy got cover through this mechanism. The third one, of course, is to put in place a group pension, which I said earlier is a win-win for the company and the employee due to the tax benefits of doing so. And it's worthwhile stressing that we do have auto enrollment coming into effect in 2023, whereby all employees and employers will be pretty much, made pay into a pension. So the advice we're giving to companies is to get ahead of the curve. And it's really about, looking at how your employees perceive you. Do you want to be in a situation where, they think that you've gone away, set up this great pension for them and are making retirement contributions for them? Or do you want to be perceived as someone who's left to the very last minute and everyone was basically forced into an arrangement without, really looking around and making sure that they're getting the best option for them and their staff? And we're happy to speak to people about, what that might look like for them. All these types of things are very, very flexible. It's easy to get quotes and they come at no obligation. And, we feel very, very strongly that it will help people promote, attract and retain employees. Finally, I just want to talk about BIK and company cars, because there is some changes in legislation coming into effect next year. So as things stand, BIK is dependent on mileage, but as of next year, the rates based on mileage are going to be increased, and people are also going to be paying depending on the emissions of their vehicles. So it's going to be a combination of both, okay? And this is presenting a massive challenge for a lot of company directors and people that have company cars. So for example, if you look at a car that was worth original market value of 37 grand, doing 25,000 business kilometers per year and emitting 150 grams of CO2 emissions per kilometer, this year it would have a BIK of 8,880 euros. So it's going to cost the person, nearly 9 grand. However, next year, the same car producing the same amount of emissions, it's actually going to cost the employee 12,500 or the director 12,500. So nearly, a 4 grand increase there. It's also unfortunately changing for electric vehicles. I can't understand why they're doing this at the moment. You have a certain amount of the original market value of your electric vehicle is not liable to BIK, but that's going to be tapered down over the next couple of years, and the exemption is eventually going to be reduced to zero, which means all electric cars will eventually over the next couple of years give rise to BIK as well. So this just shows some of the changes that are coming into place from January next year. So for example, if you look at like a category D vehicle there, and somebody who's doing somewhere between 39 and 52,000 kilometers a year, basically the percentage is 20% of the original market value that you're going to be paying as BIK. You'll notice that it does pay people to do a little bit more mileage. So if you're doing over 52,000 kilometers per year, the BIK is reduced. So firstly, it's about, I suppose, recognizing that these changes are coming into force, but also maybe looking at what you can do to mitigate against them. And also, as I said, electric cars, unfortunately, are no longer a solution to fully avoid BIK. By 2026, you can see how the exemption is going to taper down to zero there over the next couple of years. So what can you do? First option is that you can maybe ask your employer to give you a cash car allowance as an alternative to an actual vehicle. Alternatively, you can get a cheaper car. You can get a car with lower emissions. So while I said electric cars are giving rise to BIK, their emissions are obviously very, very low. So the BIK is going to be lower than other vehicles. Or to make sure that you're doing the mileage, maybe don't take a company car if you're just going to be, doing very low levels of mileage. Or probably, the smartest option if it's a runner for people is to maybe get a commercial vehicle. So I think that's usually maybe one that just has the two front seats and nothing in the back, and that's not it, that those vehicles don't give rise to any BIK at all, so you can save significantly if you're willing to do that. Finally, I just want to talk about exit planning for people who are, I suppose, trying to get out of their companies basically. There are two reliefs in existence that people should be made aware of, which basically reduce the capital gains tax on disposal of business assets. The first one is called entrepreneurial relief, and the second one is called retirement relief, and they can really be used kind of in conjunction with your pension as an exit planning strategy. So entrepreneurial relief basically is for people that are selling the business, and it basically gives you a reduced capital gains tax rate from 33% down to 10% for business assets of up to 1 million. So, if you're selling your business for €1 million, usually you'd be paying 33% on that. But with this relief, you'd only be paying 10%. So basically, you could save a company owner 230 grand there. There are some other kind of, I suppose, terms and conditions that you need to meet to get that. So worth discussing with your accountants and your tax advisors if you are looking to get yourself into a position to avail of that before retiring. The other one is retirement relief, which applies to people between age 55 and 65. So again, if you are looking to avail of this, you just want to make sure that you are getting out in that period of time. I have seen stories where, people stayed in the company a bit too long, let's say from 66 onwards, and then you lose the retirement relief. You must have 10 years of salary, and it can actually apply to two partners in the business. So basically, this allows you to take 750 grand tax-free from the business upon exit, and you can do it for two directors. So if you have, two spouses involved in the business, they can take out 750 grand of company assets. So that's 1.5 million tax free. So among things like, pension funding, entrepreneur relief, retirement relief, people can get quite a lot out of their companies in a tax efficient manner. And that's why it's so important to, get professionals on board and put, early planning in place to make sure that you're getting yourself into the best position and being able to avail of all these reliefs. Finally, for those people who do want to maybe take us up on the offer of discussing everything we discussed with us and putting a plan in place, we do actually offer a discounted rate for a financial review for clients that are on the webinar. We usually charge €199, but we will offer a 50% discount on that, so it's basically €99 until the end of the year. Now, what I would know firstly is that we do generally save or make clients thousands of euros in this process. So it is, a very, very low cost for what you get. Secondly, there are people charging a lot more. It might surprise you, but there are similar companies charging well over €1,000 a year for the same service. And what it really entails is, looking at your financial situation and your plans. As I mentioned earlier, we'd be setting financial objectives and goals for you, such as, getting your mortgage cleared when you need to, planning for kids' education, retiring early, or all of the above. We have software where we can kind of map out a future cash flow model to predict your future financial situation, see if there's a deficit, and obviously put actions in place to meet that deficit. Map out a financial plan to meet your objectives and identify ways to save you money, reduce your tax, and make your money work harder in the midst of doing all that. So if anybody is interested in doing that, some of the other areas that we can look at for you, along with the business planning that we were just discussing, is things like mortgage advice, helping people get on the ladder, review their existing, protection reviews, as I mentioned earlier, pensions and retirement planning advice, estate and succession planning, children's savings plans, something that we spend a lot of time up for clients, and the tax back savings accounts like the employment incentive investment scheme that I mentioned earlier. We are on all the main social media channels such as Twitter, Facebook, and Instagram, and my own contact details are there if anybody wants to take those down or screenshot the page, and they're more than welcome to get in touch with me following the webinar. So look, I just want to take this opportunity to thank everyone. Look, I appreciate your time on a Thursday evening in December when as I said, there's World Cup games and stuff going on. But I will give people the opportunity now to maybe ask a question if they want to do so, or if any of my colleagues are in the chat in the webinar and they want to read some from the chat box.